Welcome back to MiaV Explained. Last time the sandwich, an attack that costs a victim money. Today it's gentler cousin backrunning. A searcher does nothing to anyone. They just wait for a big trade to land and then trade right after it, cleaning up the price mess it left behind. It's risk-free because the state change has already happened, there's no victim's transaction to gamble on, and it's arguably good for the market. We'll watch a whale swap knock two pools out of line and a single backrun close the gap for a tidy profit on the real Uniswap and Sushi pools. Let's go. Here's the idea, every big swap moves a pool's price. If a whale buys a ton of WETH on Uniswap, WETH gets more expensive on Uniswap but not on Sushi. So for a moment, the same token has two different prices. That gap is a free arbitrage. Buy the cheap WETH on Sushi, sell it on the expensive Uniswap, pocket the difference. The searcher places their trade to land immediately after the whale's back running it, and unlike a sandwich, there's no risk and no victim. The price already moved, the searcher is just the first to notice and correct it. And this is the bulk of MV. Most extracted value isn't predatory sandwiching, it's this. Bots raising to arbitrage the price differences that ordinary trades leave behind. It's what keeps a token's price roughly the same across every exchange. Searchers compete fiercely to land their back rune first, paying priority to win the slot, and increasingly that profit is being shared back with the very user whose trade created it through order flow auctions and backrun rebates, an episode of its own. For now, let's see the money move. Here's the whole thing on one screen. Before the whale, Uniswap and Sushi agree on the price of WETH, so there's no free money, arbitraging just loses to fees. Then the whale fires a $3 million buy on Uniswap. Uniswap's WETH price jumps, Sushi's doesn't. Now there's a gap. The backrunner steps in right after. Buy WETH cheap on Sushi, sell it on the now expensive Uniswap. The trade nudges both pools back toward each other and leaves the searcher with a profit. The whale's own trade created the opportunity and the backrunner simply collected it. Let's build it in Foundry. We fork Ethereum mainnet at a fixed block, so we're trading against the real Uniswap and Sushi pools, with real liquidity and real prices. Everything runs locally against that fork. No real trades, no real money. We start with the skeleton, a test that points at WETH, USDC, and both routers, Uniswap and Sushi. A whale and a searcher and the searcher's RB size, $500,000. 3 empty functions set up which forks mainnet, a generic swap helper for either router, and an arb-profit helper that measures the free money available at this instant, then the test itself. Let's fill them in. First, the plumbing. Setup forks mainnet block 20 million, where the two pools start roughly in line. The swap helper routes any trade through whichever router we hand it, Uni or Sushi, and the clever one, arb-profit, it takes a snapshot, runs the full arbitrage, buy WETH on Sushi, sell on Uni, measures whether we came out ahead, then reverts the snapshot as if it never happened. That lets us peek at the free money available right now without actually trading. Now the backrun itself. First we check the arb-profit before the whale does anything. We expect roughly nothing. The pools are in line. Then the whale fires their $3 million buy on Uniswap, knocking its price out of line. And immediately after, the searcher buy WETH cheap on Sushi, sell it on the now expensive Uniswap. We log the profit and assert the searcher came out ahead. The key is the ordering. The searcher's trade lands right behind the whale's, backrunning it. Read it once more before we run it, measure the arb before, then the whale swap, then the searcher's two-leg trade after it, Sushi then Uni. The two numbers we print tell the whole story. How much free money there was before the whale, which should be none, and how much after. Let's run it and see the real figures. Run it and read the two numbers. Before the whale, the arb-profit is negative, about minus $42,000, meaning there's no free money at all. Try to arbitrage two aligned pools and you just lose the fees. Then the whale buys 740 WETH on Uniswap, knocking it out of line. Now the backrunner buys 121 WETH on Sushi and sells it on Uniswap and gets back $510,000 from a $500,000 start. Profit about $10,000, risk-free. Created entirely by the whale's trade. Green means it worked. One more thing, because a passing test on a local fork can feel like a sandbox. To show the mechanic is real, I rebuilt it as a minimal 2-pool lab, one Uniswap style pool, one Sushi style pool, and deployed it to Sepolia, a public Ethereum testnet, through my own Chainstack node. Then I fired the exact same sequence as the real transactions, the whales swap, then the searcher's 2 backrun legs, landing in 3 back-to-back blocks. The numbers are smaller than the mainnet fork. It's a toy-sized lab, but every transaction is signed, mined, and permanent. Let's read the 3 that tell the story. Here they are on Sepolia's Etherscan 3 consecutive blocks. Transaction 1, the whale. Look at its 2 token transfers, 3 million mock USDC going into the Uniswap pool and 987 WETH coming back out. That big buy drains WETH from the pool, so WETH is now more expensive there. The price is out of line. Transaction 2, the backrun's first leg, the very next block. The searcher's address now 500,000 USDC into the Sushi pool, which is still at the old price, and 166 WETH out, bought cheap. Transaction 3, the second leg, the next block again. The searcher sends those same 166 WETH into the now expensive Uniswap pool and receives 505,294 USDC back. They put in 500,000 and pulled out 505,000, a $5,294 profit, risk-free, and notice the whale is untouched. There's no victim. The searcher just corrected a price the whale knocked loose. 3 transactions, 3 green check marks, all on a public chain you can open and verify yourself. Quick recap. Backrunning is arbitraging the price gap that a large trade leaves behind. Before the whale, the 2 pools agree, so there's no free money, only fees to lose. The whale swap depegs one pool, and the searcher's backrun buys the cheap side, sells the dear side, and closes the gap for a profit. It's risk-free because the move already happened, and victimless because it corrects prices rather than exploiting anyone. This is most of what MEV actually is, quietly keeping the market's prices honest, one backrun at a time. A quick note. Rebuilding these strategies safely on real forks and explaining them line by line takes real work. If it helps you, the wallets are on screen and there's a Ko-fi link below. Every tip funds the next breakdown. Thank you. That's Backrunning, the risk-free victimless arbitrage that makes up most of MEV, built on the real Uniswap and Sushi pools. Next episode, liquidations. How a searcher repays someone else's underwater loan and seizes their collateral at a discount, one of the biggest and most competitive games in DeFi. Subscribe so you don't miss it. Tell me in the comments which MEV topic to break down next, and I'll see you there.